Welcome to the Elite webinar. Riz here, I'm hosting. Chris is on vacation, so without further ado, let's kick things off. We had a tremendous, fantastic rally in the market this week. A bit surprising, considering we had a significant downtrend that we were in. And again, I will say that we aren't all in the clear, but let's kind of demystify and break down what happened this week. We had pretty much all green days, give or take, besides Tuesday, which was really, really, um, let's just say, you could see this a doji here, if you want to call it that, indecisive. But other than that, we had pretty much a straight 5 day run up. I think this counts as pretty much a neutral day, but let's just say, a straight fantastic week where the S&P 500 gained about 6%. After kind of getting that 3800 area lows. And in fact, I hope if you're since you're watching this live, I hope you had the chance to scale in. I'm not going to go into the specific trading game plan, because in case people are watching this afterwards, and that game plan is for elite members only. But I hope you had the chance. I did give an update last week, not this week, but the week prior, to consider scaling in, as we were below the second tranche, if you know what I'm talking about. And if you did get in, especially after the first and second tranche to contribute, you should be doing pretty well. Because this massive rally has pretty much raised uh, the waters for pretty much all stocks. And the question now remains to be seen if we can carry this. Keep in mind, this 4,200 area is a pretty significant resistance. Okay, not exactly 4,200 here, but I'm going to increase it. But you get the idea. 141.50, 41.60 is kind of like a resistance area, and we need to see if we can break above. I said during the week that 4,100. If we get a nice push above 4,100 right here, we could see a good breakout. And not only did we see that, it just continued to run up to 41.56 here. So really, this is a short trading week. Like I said, it's long weekend in the U.S. Markets are closed on Mondays, so it's kind of tough to say what's going to happen. We've seen that on these long weekends, markets close for 3 days in a row. It kind of a bit of a toss-up, really, on Tuesday. We still, need to be cautious, because I wouldn't say, okay, you know what, this is all good. We're going to 4,600 or higher. No, I think we've seen these runs before. Take a look at this, right? Draw your attention to March, middle of March. We've seen a run, and everyone kind of thought, okay, this is it. We're back to normal market. And nope, that was a big, big, big fake out. And we just went straight lower, right? So we don't want to see something like that happen and then be caught with our pants down, so to speak. So we don't want to see, the market come up here and then break out, which would be great. But then there's going to be points in time we're going to see more resistance, and I wouldn't be surprised if we see lower. Like, the reason market ran is, we had some decent PCE inflation numbers. So again, it's not CPI; it's a different type of inflation metric, and that is a different calculation, different percentage, but it's not too bad. That's why one of the reasons that markets rallied. Now, with that said, if we see a breakdown from, let's say, even 41.65, or maybe we get a nice push to 42, 4,300, and we go lower, you do not want to be in a situation where you bought at certain areas and you didn't take any profits. In this market, you want to consider taking profits sooner rather than later. And I know you're probably thinking, well, Riz, we have solid companies. I bought great companies, the tiered buy list. They're great companies. I love them. They're not going anywhere. Why should I sell? Well, as great as a company can be, we've seen things like Microsoft and Amazon and Google and Apple still go lower alongside the market. So you don't want to use your chips, use your ammunition, so to speak, your capital, and then not have much in reserve after you already had some green in your portfolio. So what I recommend doing is letting some run and taking some profit. So now you're kind of, you bank some, you book some gains. You're not simply just waiting and hoping that we continue to push up and go higher, right? Because that's not a really a great strategy, to just hope. I would say you need to be a little bit more active, and a little bit more aware of what's happening. And you know what? If that means if we get a breakdown, then at least you will have secured some gains, right? So that's what I continue to recommend. I feel like we're kind of in a still, we're not kind of, we really still are in a downtrend in the uh, broadly speaking, right? So don't forget that we've seen these, bear market type rallies, and we've seen it before where the market hits a 20% drawdown and it gets bought up. It's the second time that's happened. So from the peak here, the market hit a 20% drop here, ran up here. Look at this, right? Picked back up. And then it happened very close again, uh, not this week, but the past week, before that. And it got very close to hitting bear market again, and then it got bought up, right? So this actually isn't uncommon. It's not uncommon for bear markets to have literal mini rallies, like rip your face off rallies. We saw it here. I'm gonna, make a circle here. So look, we saw it here, right? We saw it here, and maybe this is it too, right? Question mark here, right? That's that's why I'm cautioning that you don't go into FOMO or like, yeah, I don't want to miss out on a further rally because you're assuming that it's going to go up. But prior occurrences, like here, tell us that this could very much still be a downtrend. We could still be in for some further lows. Okay. Again, not absolute. I'll speak for everyone. I'll gladly be wrong. I'll be glad to be wrong if we, continue to see 43, 4,400 on the index. But I'm just sharing probabilities. I'm sharing based on historical occurrences and my experience. We are still in a high inflation environment. We're still in a rising rate environment. We have seen many companies, especially retail, Walmart, Costco, um, Target, inventories building up, and I have a whole document for elite members on what to look for in a bear market or a recession. There's a bunch of documents. Hopefully you've, resources. Hopefully you've gone through that. Please go through it. There, literally in there, it will say one of the things: rising inventories are a sign of a coming um, recession. Now, again, don't think recession is the same thing as financial collapse like 2008. Okay, it doesn't need to be that extreme. But we did already have a negative GDP print. If we get another one, we're kind of in a recession at that point. So something to be aware of. Okay, so next GDP print is going to obviously be important, and inflation still continues to be a bit higher. Uh, a lot higher actually. And let's face it, oil prices haven't come down yet either. So moving on, let's take a look at the asset classes here. Um, I have a pretty busy screen here, so bear with me compared to Chris's, which is a little bit more simpler. But I'll touch on the a few different asset classes than we usually do. And the first one on the top left being the 10-year Treasury yield. Paul in the elite team, he's fantastic. He gives updates as well in the morning on Treasury yield. So this is the Treasury 10-year Treasury bond, right? Government bond. And when the yield goes up, that means, guess what? There's flight into um, more safe haven type assets. Bonds are a little bit more safe. Treasury bonds, government's bonds are one of the safest, so to speak, instruments, financial instruments out there. So when we see, bonds yields up, that means, look, people are looking to, people are looking to take capital out, and they can get a safe, relatively safe return. This is a yield. Yield just means percentage return, annualized for 2.74. So a 10-year bond, okay, for 1 year gives you 2.74% interest, right? And you can see that's been going up, uh, especially this year. Look at that. Look at that velocity of the gain. So when yields go up, bond yields go up, that means there's more return for having next to no risk. And bond yields go up for many reasons. One of them being a rise in benchmark rates. Why are they called benchmark rates? Because they're literally like the floor. So if the floor keep coming up, it raises the tide, raises the ocean levels for everyone, right? So bond yields are no different. When bond yields go up, we see an inverse correlation in tech. So tech usually comes down when bond yields go up. In fact, if you don't believe me, take a look at what happened in the last 5 days here, right? Down, relatively down, trending, and tech and the market as a whole, especially the NASDAQ, was ripping, right? Let's bring up the NASDAQ, right? Take a look at the NASDAQ, right? Similar chart pattern, similar chart, similar price action to the S&P 500, right? Very similar. I just flipped it there. So keep an eye always, not always, but we continue to keep an eye and monitor bond yields, especially the 10-year. Moving on to the right side, I have the oil price, oil futures price, right? This is price per barrel. I mentioned not last week, but the week before, that I wouldn't be surprised if oil gets to around 115, and this is where we are now. And I even said maybe, again, I didn't make a guarantee. I said maybe I might consider shorting oil at 115, 120. So you don't have to be too much of a genius to consider that maybe potentially we might have an oil short placed at some point in Elite. Again, don't go out there on Tuesday and just go and fucking short oil via an ETF or futures. Okay, I'm just letting you know that perhaps. Okay, so that's something to consider. Not much else really to say about oil besides the Ukraine-Russia conflict continues. If there's any headway or any positive news in that, we'll see oil come right down, not to 70, 80, but like it will definitely pull back to the $100 mark, maybe a little bit lower, which will be good for the average consumer because that will then bring prices at the pump down. Plus, it will be good for the general economy, or as a result, inflation. One of the largest factors for inflation being very high is oil. One of the reasons, right? One of the largest factors. Bottom left, we have gold making a little bit of recovery from the 1800 level. Not very interesting. We just keep an eye on gold just as an idea, as it used to be, somewhat of a safe haven asset decades ago, but not really so much. The U.S. dollar currency index. So this is the index that compares and correlates. It's essentially a basket of all the different large currencies and compared to the US dollar. So this doesn't mean this is comparing the US dollar to the Canadian dollar, the US dollar to the euro, or the US dollar to the GBP. This just means a US dollar compared to all the other major currencies, and then essentially wrapped up in one nice number. So what does this mean? It means that the US dollar over the last couple of weeks compared to the other major currencies is weakening a bit, but it's been on a tremendous run. In fact, the second best performing asset class this year is the US dollar. Okay. So think about that for a second. Remember all those crypto junkies telling me and all these crypto people, the US dollar is the death of the US dollar. And, it's going to be the collapse and it's over for the US dollar. Well, what's done better than the US dollar? The Russian ruble. Who would have thought, right? So here we are in an upside down market where, we have asset classes that really people were calling the end of. And I said it many times before. I said, look, the US dollar has survived not only the U.S. but the U.S. dollar specifically as the world currency, the reserve currency, has survived plagues. It survived world wars one and two. It survived many um, geopolitical conflicts. It's survived many different smaller wars throughout the years. It survived a global pandemic just in the last couple of years. So it survived all that and it's been running, right? So here's a long-term view going back to 2020 US dollar index. Look at that. Very strong, very strong, right? So yeah, whoever has been calling for the doomsday and the end of the US dollar and even the end of the US, I think they need to go back to whatever hole they came from. Um, so that sums it up. A little bit of a different take this time around than what we're used to when Chris runs it. I go a little bit into the details around different asset classes. So hopefully you enjoyed that. Um, let's move into some questions. All right. I have a couple of questions I'm going to run through first that someone has sent me, people that sent me because they couldn't be here on the webinar. And then in the meantime, you guys can type yours and I will tend to them. Okay, the first one, the question I have gotten is on Nike. Sorry, let me get rid of this. Oops, Jesus. Okay, so Nike. This is a company that's pretty much followed the broader market, has tanked alongside everything else. And it's not a tech company, obviously, but nonetheless had a good week as well alongside the market as a whole. We do know that from a fundamental standpoint, this is a solid company. People ask me, Riz, what do you think about it? And obviously, I have a position. Um, if if I have a position, that kind of tells you pretty much everything you want to know. That for better or worse, I feel like this is worth carrying. I have a position; it is in the red, but that's okay. Pretty much, you know, all stocks are down year to date. So if you bought anything this year at any point in time before last week or the week before, you will most likely be in the red on a position. So Nike is a great company. I think if you are looking to kind of diversify, get into some consumer discretionary, this is one of those. I wouldn't go too heavy. We do know that people need shoes, but I wouldn't be surprised if people don't spend as much if we see a recession on the high profile, the high dollar cost shoes, right? They'll still buy shoes, buy Nike, but it's not going to be, I wouldn't be surprised if their inventory levels go up. I wouldn't be surprised if revenues decrease a bit. But nonetheless, you can see from where they were at the end of last year and start of this year to where they are now. Is the market's discounted a lot of that already, right? Another question I have is from another elite member on Apple, and he asks, he has half a normal size position at 141.82. So that's a great, decent entry, almost near the lows, right? And now he has another position. He's pretty much full position now, and he's asking, what should he do? Should he take some gains? And yeah, we could look at the weekly chart. He says to look at the weekly chart and how Apple bounces off the 100 EMA. I'm gonna keep things simple. I think, like I said before, it's not a bad idea to take some profits. It's not. I can't blame anyone for booking some gains. You don't need to get scared out and take everything off and go completely cash. But taking some gains along the way, especially if we have a green week, yes, it would be foolish not to take profits if we have another, solid 2, 3 green days this week. Period. I'll be taking some gains too if I got some. So it would be foolish not to. All right. So please, if you have even a tremendous, fantastic company like Apple, when I say take some off, let some run, if you have, let's just say, $10,000 of Apple, I'm giving an example. You have 10K in Apple, and you're in the profit. Maybe your break even is like 144. So you're making maybe nearly $5 per share, right? What do? At the very least, very least, you want to have, okay, so this is a solid plan I'm giving you here. You want to have uh, about, let's just say, a trailing stop or a mental stop at your break even. In this market, even if it's Apple, avoid carrying a profitable position and letting it go red. Okay, avoid that right now. It doesn't matter if it's Apple, Nike, whatever, tech stock, doesn't matter. Okay, avoid having a profitable position go in the red. But what you can do once you have your trailing stop here is maybe it will continue to go up, maybe have a profit stop right here at break even. And as it continues, assuming Apple continues alongside the market or whatever, it moves up to 155. Okay, that's fantastic for you. Maybe next week, no matter where it opens, maybe it opens at 150, still take some off. Instead of having 10K, you now have 7K in it. Jesus. Okay, definitely can't write with that one. Oh, you gotta use. Whew. Okay. Let me type this. So you then turn 10K, 7K. So you sold some. Okay. Now, what happens if it continues further? What if okay, again, I don't think the probabilities are high, but what if it continues to go up and then it goes to, 160? Same thing. What you want to do is take another couple grand off. Again, this is assuming a 10K position. But really it's percentage is what matters. Take off 25%, take off 30% at a time. And then, you now have 5K, right? 7K to 5K. So that's how you want to consider scaling out. All right. Again, this is just a guideline. Do as you please, but this is a guideline. You don't need to do exactly, these percentages, but ultimately you want to scale out. Worst case, let's assume the market next week, it says, nope, tricked you guys. We're not going in recovery. We're going to puke this time again. So the market goes lower, Apple goes lower. It touches your break even. Maybe you have a stop here, trailing stop. You're out. Okay, you're out. Just take it off. Okay, out completely at break even. Maybe small profit even. Okay, you're out completely. In this environment, don't hold anything that you have profits on, even if it's a fantastic company. If you're looking to trade, like if you're looking to swing trade, if you're the type of person who doesn't give a shit if it goes up, down, sideways, whatever, and you are completely 100% okay with it going down another 10%, another 20%, and you don't care what happens and you're going to hold this thing for the next year or two, then what I just said doesn't apply to you. Okay, what I said applies to someone who's trading or swing trading in a little bit more of an active fashion. Now you may be thinking, Riz, I got a red position here, like your Nike position and others. I have a red position. What do I do? If it's a solid company, okay, if it's a good company, if you have your conviction in it, you have a thesis, you're not overexposed to the company, like you don't have like 60% of your account in it or 40% of your account in it, it's okay to carry it even in a market like this. You don't need to book losses on great companies. You can maybe consider averaging in. Again, everyone's situation is different, but please consider that this plan applies to people that want to actively swing trade a bit, whose time frame is a little bit shorter, and of course, doesn't want to be just carrying and be led by the caller of this market. Okay, hopefully that adds some context for all of you. I have a question here from Jazz. Thoughts on if you haven't gotten into Walmart yet? I was hoping my short put to get a sign, but it rallied right on. Okay, at least you made some money off the short put. Walmart is one of the positions I have. Obviously, as you would know when you lead, and a tremendous rally. I'm very happy with that one. Now, what would you do? What would you do? In this case, This one is a precarious case because, like I said, their earnings weren't that bad, but they also weren't stellar. And I mentioned in the beginning of the webinar, they had an increase in inventory, which is usually bad news for not only just these companies individually, but bad news for a sign of things to come, potentially uh, on an economic level, right? An increase in inventory means that, guess what? People aren't buying as much as Walmart is used to, selling, right? These big, large, huge retailers have an idea what product will sell in a certain amount of time, how much it will sell, and how long it will be on the rack for before it's gone. So when someone like Walmart, who's pre-purchased and gotten all this product, and it's not going off the shelf as fast as they expect, what's happening? They've used capital for things that are sitting on shelves that will take longer to be gone. In some cases, we might not be gone for a long time. So that's the worry. When Walmart sees an increase in inventories, what do? They're going to have to react and say, okay, we're ordering less. So when they order less, their supplier is making less money. And when the supplier is making less money, that supplier is not going to get as many raw materials. So the raw material producer is now making less money. So you notice this whole impact to the whole entire food chain or supply chain, right? If you want to call it. So this is where you want to be cautious. It's a fantastic company, great company, very much was oversold. And to give you an idea, it had dropped about 26% from the highs. Right now, it's about 20% from the highs. So still, I'm not going to say Walmart was worth, 160. Dollars per share in a couple of months ago. I think it was still a bit overdone. But when I got in and where it is now, I like it. I like it. I personally would maybe take a starter and then leave some in reserve and maybe do some short puts here around 120 and 122, maybe if you're feeling up for it. Okay. But taking a little starter is fine. I would not go full position uh, right now, especially off the back of a market rally. If we see the market go lower, puke, then I wouldn't be surprised if maybe we see Walmart pull back a bit. Not as much as some tech stocks, but maybe it will pull back a little bit too. All right. Um, so that's kind of my 2 cents on that. If there's any questions, let me know. Otherwise, we shall wrap it up. I see someone typing. So wait a second for that. Hopefully, you guys like the kind of a detailed breakdown around what to do based on what happens in the markets. Remember, like I've said many, many times before, uh, we literally, we're not trying to tell the future. We're not trying to say this is exactly what's going to happen. All we're trying to do is look at probabilities and have if and then statements. Okay. I got a question here. Riz, I'd like to take long position on shop. Do you think it's a good entry now or wait for the market direction? Yeah, this is another company that's been absolutely slaughtered. I think it's like a 70% drawdown from the highs. Let's do it. Let's do the math. I know they announced a split many months ago before this entire meltdown. Look at this, 78% right now. Wowzers, right? They had announced a split many, many months ago, and it's happening from what we see, according to TradingView on 29th June. Yeah, I think if you like tech stocks, you like these kind of growth stocks, e-commerce stocks, I think this is a good entry. Again, be open to adding and not taking a full position just yet. I always recommend not taking full positions right away in one go in this market environment because we know it's so hard to get your entry right when this market is completely whipsawing. It goes up and down. Yeah, last week was pretty great, green, but that's not common, as you know by now this year. So if you are looking at shop, you like the company, and you have the risk tolerance for it. It's very volatile, moves big. Just be aware of that. It reminds me of Tesla back in the day because, uh, it's a large cap, very different company, but it's a large cap like Tesla was, yeah, and still is, but really back in the day, Tesla used to move big. It still does, but even more. It used to move a lot bigger, right? It used to be crazy candles on the dailies, right? So it's something to kind of consider and think about. But yeah, you have my blessing if it's something you have the ability to carry. Personally, these are one of those kind of companies where you have to have conviction in it. It's a growth stock. It very much has to do with the broader market. If market continues to go lower, don't be surprised if shop also does, because right now this 300 area is a nice support, so that's good. But we've seen with something like this, it doesn't really matter where support is. It could just completely break lower, and when we have a nearly 80% drawdown, this is not a bad entry point. Okay. Um, all right. Looks like I've answered the questions. Um, Hopefully, uh, this kind of open your eyes around what's to come. What to expect this shortened um, trading week, so Tuesday to Friday. Hopefully have a great long weekend, or regular weekend wherever you may be, and you know be agile. Again, like I've said, no one can tell the future. No one knows exactly what's going to happen in the market, and if anyone pretends like they are or talks like they know, that's an easy way to know who's lying and who's bullshitting, right? So all we can do is protect our positions, protect our profits, use due diligence, use proper risk management principles, all that good stuff, right? That I talk about and implement myself in my day-to-day trading. So yeah, it's been great being on. I believe Chris should be back for the webinar next week, and hopefully I'll probably be able to join him as well. But he will be back to hosting. Hopefully you guys enjoyed it. Me hosting, I didn't make a complete mess of things. um, and yeah, it's been awesome. Have a great weekend, everyone. Be well, enjoy the weather wherever you are. And we'll be back in action this week. Cheers.